Financial Instruments video lecture. In this lecture, we're going to be dealing with extinguishment of liabilities with equity. So this basically deals with recognition and measurement. So you find this in your IFRIC 19. Make sure you know where to find it in your standards. So a debtor and creditor might renegotiate the terms of a financial liability, with the result that the debtor extinguishes the liability fully or partially by issuing equity instruments, right? So these transactions are also known as debt for equity swaps. So you need to know what IFRIC 19 applies to. So it applies to the accounting by the debtor when the terms of a financial liability are renegotiated, resulting in the entity issuing its own equity instruments to a creditor of the entity to extinguish all or part of the financial liability. So this IFRIC sits to deal with whether entities equity instruments issued to extinguish the liability, consideration paid, as well as how you would initially measure the equity instruments issued, as well as identifying how to measure the difference between the carrying amount of the financial liability and the initial measurement of the amount of the equity instruments issued. Like, how do you treat that difference? Do you take it to P&L or CI or directly to equity? Extinguished. So if a debtor issues equity instruments to a creditor to extinguish all or part of the financial liability, those equity instruments are considered to be consideration paid, and as such, the debtor needs to derecognize the financial liability fully or partially. So you're derecognizing your financial liability and actually recognizing that you've issued additional share capital, and then the difference would be your gain or loss in settlement. So how do you measure those equity instruments? So the equity instruments issued are measured at fair value, unless fair value is not readily determinable, in which case the instruments are measured at the fair value of the liability extinguished. So you're going to measure the additional share issue at fair value, and the loss or gain that arises when the equity is measured at fair value of the equity which is used is either the greater or the lesser than the carrying amount of the liability. So the difference shall be recognized in your profit or loss, and the entity needs to disclose a gain or loss recognized in accordance with para 9 or 10 as a separate line item in the profit or loss, or you could show it in your notes. So what happens where there's a partial extinguishment? So if only part of the liability is extinguished, the debtor must determine whether any part of the consideration relates to a modification. And remember, we said if it's a modification, you're not worried about it. You just need to match at a awareness level, which means that extinguishment that relates partially to a modification is not part of your scope. And if it does, the debtor must allocate fair value of consideration between liability and extinguished, between the liability extinguished and the liability retained. So because this deals with modification, you just need to be aware of it. If the remaining liability has been substantially modified, account for the modification as extinguishment of the original liability and recognize a new liability. So let's go through an example. So Friendly has 5 million authorized shares and an outstanding creditor with a fair value of 200,000. Of the 5 million shares, 4.5 have been issued. Since the company is growing, so they still have potential to issue 500,000 shares. So since the company is growing, it is experiencing some cash flow challenges, and it has decided to approach Happy with the proposal of issuing shares in Friendly to Happy in full and final settlement of the 200,000 owing to Happy Limited. Happy agreed to the proposal, and the shares in Friendly were issued at their fair value of 5 Rand per share to Happy on the date which the creditor was supposed to be settled. So what's the issue here? Are we the debtor? And yes, we are. So if we are the debtor, we need to deal with this in accordance with our IFRIC 19. So we need to de-recognize our liability at its carrying amount and then take note of the fair value of the equity instruments and recognize a share issue of to that amount. And because we're extinguishing the liability in shares in full and final settlement, we're just going to issue shares worth the 200,000. So in this case, we wouldn't have a gain or loss. So just debit your financial liability and credit your share capital to show that you've issued additional shares. And then in this case, the difference is that AP agreed to the proposal of 45,000 shares. So in this case, they're not trying to link the value of the shares to the liability outstanding. So they're probably getting a higher value. So your share capital will be recognized at its fair value, which is your 45,000 times 5, and you do recognize your financial liability at its carrying amount. The difference is therefore a loss on settlement of 25,000. Okay, so as you can see, the main issue here is just identifying whether you're the debtor, and if you're the debtor, then say, okay, fine, I can actually, how am I going to account for this? I need to recognize the financial liability and recognize the share capital that I've actually issued, and share capital will be at its fair value, and then determine whether there's any gain or loss on settlement, which will go to your profit or loss. Okay, thank you for your time. I hope this video was helpful.